Awesome. Well, the moment that we all been waiting for. This time I am excited to share this team of tax expert that are based out of Bangkok in Thailand. They specialize in tax preparation for expat, and most of their clients are across Southeast Asia region, say Thailand, Japan, Korea. Gonna move to the next. They both have a decade of experience in US tax issues for expat and military investor and specialize in simplifying tax complexity for those living abroad. That's even hard to say. So, you know how much they know. I am super stoked to have both of them here and, to have them share a wealth of knowledge with us and how to navigate foreign income taxes. So, income taxes are not only hard, but then you have foreign income taxes to add to it. So, again, welcome, James and Susan. And at this time, the floor is yours.
Good morning, everyone. Very happy to be here today. I want to try to take a fairly complex topic and get to the meat of the parts that hopefully that you can use. And of course, we'll take questions at the end. And so we're just here to talk a little bit about navigating foreign income tax and the requirements that you have as a U.S. citizen living abroad. I want to start first by sort of going over what some of the common mistakes are that we see folks living abroad make. And that number one mistake is not filing a tax return at all. A lot of folks think that when they're living abroad that the United States no longer can tax their income, or maybe they've heard that it's excluded up to a certain amount, usually a pretty big sounding number, and so they just don't file a tax return at all. And that is typically the biggest mistake that we spend a good bit of time helping people come back from. Generally, you want to file a tax return, even if you might not be required, if your income might be under the filing threshold when you're living abroad, just to protect your statute of limitations. That statute of limitations only starts when you file a return. So just having one on file will protect you a lot of times. Now, that doesn't apply if there's fraud or in some other extreme cases, but for the most part, that means that the IRS can't review your return after about 3 years. And the next thing that we see is failing to include all income, including your foreign and your U.S. source income. As I just mentioned, U.S. citizens have to file and pay their taxes annually, and the United States taxes all of your worldwide income. A lot of people know this by now because it's talked about a lot, because it's the only country really that does this, the only country of any size. So that's all of your income earned in the U.S., all of your income earned out of the U.S., and that includes both income from work and income from your investments, like your real estate investments. Missing important deadlines. You want to make sure that you're getting things filed on time. That's another thing that protects you. When you don't file something on time, sometimes the IRS is not required to give you that credit, that exclusion. We see sometimes folks don't adjust for differences in the way that income is calculated. Maybe you have this foreign rental property in one country, you're reporting that income to that country, and they require that you use certain methods to determine that net income. They might be different in the US, and you can't simply transfer the number of your net income from one to the other. You have to calculate them separately in most cases. I'm not going to spend a lot of time on PFICs or passive foreign investment companies, but I want to touch on them because if you are investing overseas, if you are buying properties outside of the United States, if you place those into certain types of corporations or trusts, you could create something that the US government considers a passive foreign investment company. If you do that, you have created something that requires a lot of additional handling and work and reporting, and sometimes some punitive taxation.
Yeah.
Another common mistake that we see is excluding the wrong income, excluding income that's passive rather than only your income earned from work. It is called the foreign earned income exclusion. That's the full name of that exclusion, that $126,000 or so of tax-free money. But that only applies to income earned from work. Also, not considering tax credits. that may be available to you. We see, and I think where we were getting with a question a little earlier in just general chit chat was if you do take that foreign earned income exclusion on income earned outside of the US, then you might not get credits that everybody else is getting back home for your children and for other things because that income exclusion disallows those credits. In most cases, you're paying taxes where you're earning that income. And so sometimes the better method in your case may be to take foreign tax credits and forget about that exclusion, as wonderful as it sounds, because that may be beneficial to you. So I'll talk a little bit more about that a little later. But not considering those tax credits and going straight to that exclusion sometimes leaves some money on the table.
That's awesome.
Of course, you want to maximize any benefits that you can get from working overseas. That exclusion, those tax credits, the exclusion from work doesn't apply to active duty military pay. That's not excludable under the foreign earned income exclusion. Of course, combat pay has its own special exclusion if you are receiving that. Your foreign tax credits, like I just mentioned, they will offset for the same type of income. So if you're paying tax on your rental real estate, then you can take credit for that on your US tax return. And I'll talk a little bit more about that too. And then just a reminder that while you don't typically pay, in fact, I don't think you ever pay a tax to a foreign nation for your US military pay, if you have another job or you've started a business in that country or you're investing or you're buying property or you're renting out part of your home, you do have obligations to that other country and to the United States. So as I've said probably a few times, but I think it generally bears repeating, US citizens and permanent residents, folks with a green card, are taxed on all of their worldwide income, regardless of where they live and regardless of where they earn that income. Our favorite way to relieve that double taxation is from foreign tax credits. The exclusion has its place, and certainly we do advise people to use it, but those tax credits can be really valuable, especially when you have a mix of different types of income. Investment income allows for that foreign tax credit if you're paying a foreign jurisdiction on that. Differences in how you calculate, and I'm going to talk a little bit more about that too, or something that can sometimes lead to unexpected tax outcomes. Sometimes you can have the same situation for you that's considered a profit in one calculation and a loss in another. And again, I'll talk about that a little bit more in just a moment. Also, you can actually have more than one country involved here. So perhaps you buy a property while you're stationed in Japan, then you move along to somewhere else and you have income there. Maybe you take a side job or start a business there, and then you still have the US involved. So you can end up with multiple countries when you move around and you invest as you go. All right, so I'm just going to talk about here. I just chose the US and Japan. I'm going to give a very simplified sort of example here. And it's going to be different, obviously, in any country that you go to. But the reason I'm going to walk through this is I just want you to be aware that it is sometimes more complicated than it looks like on the surface. So in the US, if you have rental property, if you're renting out a home that you own, an apartment that you own, or even part of your own home, that is generally considered passive income. On your US tax return, if you have losses from that passive income, they can only reduce tax on other passive income for the most part. Now, if you're a single individual and you make less than $50,000 a year, or if you're married and you're making less than $100,000 a year, you may be able to deduct a portion of that in the current year against your regular earned income. But typically, it's only going to be able to offset passive income. In Japan, if you have, for example, if you have losses on your rental property and you also have income earned from work in Japan, they can offset each other. And that's going to vary, like I say, from country to country. And some may do it an entirely different method than this, but it's just something to consider. For the investments that you hold, it's considered long-term in the US after 1 year and 1 day. It takes 5 years to get to that status for capital assets held in Japan. The rates vary through the US, and all of your income is considered to determine what your capital gains rate will be, and that can be nothing. It can be 15%. It can have an additional tax on top of it if you've got a lot of income, and anything less than a year is considered ordinary income. In Japan, that capital gains tax, as best I understand it, I'm not an expert on Japan, so if somebody knows differently, let me know. It's calculated completely differently, so it doesn't have anything to do with all of your other income. Another example here, this is something that I wanted to call out because this really varies widely from place to place, is how you get to that net income that's taxed. So here, what I want to talk about is we have someone who purchases a property for 40 million yen. And my numbers, my translations here are all rounded and trying to just keep it simple. And that building value in there is 14 million yen. So in US numbers, I'm using $90,000 for that building and $256,000 for the land. And where we have a big difference here in the way that we account for the net income that's reported on a tax return is the way that the building is depreciated. So the land isn't depreciated in either case, but the building is. In the US, if you bought that property and you placed it into service, which means you began using it as income producing property, then you depreciate it over 30 years if it was placed into service after 2018, and 40 years if it was placed into service before then. In Japan, it's a lot more complicated than that. So it depends on the type of structure, what it's made from, when it was built, how long ago it began, or I'm sorry, how long ago it was built and what it was made from. So wooden structures, concrete structures, they have different depreciation schedules. So in the example that I'm using, I'm not going to get into that in much detail, but I picked one where it's a wooden home that was built 12 years ago. So that one would have depreciation of just 7 years. So that's going to give us a very different expense in that category. So to simplify that, what we do is we take that number of the building purchase, the $90,000, and we divide it by the number of years we can depreciate, and that gives us our expense on an annual basis. Doesn't always work out that cleanly, but for today, that's how we're going to do it. So in our US one, we have here depreciation, oops, clicked where I didn't mean to click, of 3,273. And over here we have depreciation of 2 million yen. So the number, I didn't translate this final number here, but these other numbers are roughly the same. Rental income, there's no difference in the way that's calculated. It's the amount of rent that you collected. In here for other expenses, I'm referring to things like property management fees, property taxes, or they may be called something different depending on where you are, but taxes that you have to pay to own the property or taxes that you may have to pay for the privilege to rent it, like a business tax. So if those are the same, and we're just gonna for today pretend that these numbers equal each other, and this depreciation is where we have a big difference. So here we actually have a net income that's going to be taxable to us in the US of close to $8,000. It's probably not going to be a huge tax, but it's going to be something. And then we have a loss on our rental under the Japanese method of figuring this out. And the reason I call this out is because we'll have folks that come in and they might just bring us a copy of their tax return and give us this number and just say, I had a $230,000 loss on my rental. And that's not the case. Because we have to recompute it the US way. See this a lot with people who own property in the US too, because they think their mortgage payment is an expense, and it doesn't quite work that way. That's where depreciation comes in. Also, you'll note there's nothing to account for the expense of the land. You're holding that land separately, sort of as a separate asset that typically is going to appreciate. No matter where we are, we tend to see land appreciate in value. I talked a little bit about the tax credits before. I want to talk a little bit more about them now. I'm also not going to get into a ton of detail, but we will be available to answer questions again at the end. So the tax credit, the way it works on the US side, is that it's limited to the lesser of the actual foreign tax or your US tax liability on that item of income. Typically, this isn't a huge deal because most of the time US taxes are are lower than the foreign taxes. Where that's different in a lot of cases is capital gains. As I mentioned before, I had to think, I might not have read out the numbers, but I had on the slide, the capital gains taxes in Japan, for example, are a lot higher than they are in the US. So you might pay $1,000 in taxes and only see a $200 credit on your US tax return, but that's because it can't reduce your tax to less than zero. There's no refund available there. If you're doing your own taxes through one of the do-it-yourself software companies or services, sometimes you'll be given the option to check a little box that says you're going to take the credit without filing Form 1116. If you do that, you don't get to carry over any tax. You don't get to carry back tax, which is a little bit less common. This doesn't come up a lot, but for some folks that are doing it themselves, I just want to point that out. Don't make that election to file it without that form, even though it might mean that's a few screens that you don't have to fill in the data for, because you could lose some benefits that might be very valuable to you. And the tax credits only apply to income taxes or taxes in lieu of income tax, like a capital gains tax. They don't apply, they're not applicable to things like social insurance and that type of tax. There's no credit, there's no direct credit for a property tax, although you can deduct it on your rental income and on the US return. Your credits are calculated separately for your passive income and your active or earned income, and you can't mix them together. One can't offset the other. And if you use that foreign earned income exclusion, you can't take a credit on that same income, but you can still have a tax credit on that return. So if you have other types of income, or if you have more income than the exclusion allows, you can take credits against that, but they are going to be prorated. And they're not fundable, and they're not applicable to sources of general income or other taxes. It has to be like for like is sort of the key point here. Filing requirements. June 15th is the deadline for taxpayers who are living abroad. And that's all taxpayers living abroad, whether you're in your active duty phase, whether you're retired, whether you're the spouse or the dependent, or someone else who just came along, a mother-in-law. If you're living abroad, you have till June 15th to file your tax return. You don't have to do anything special for that to happen. That's automatic. You do have to note on your return that you're abroad. There's a little special place you can check for that. Otherwise, the deadline is April 15th. April 15th is the deadline to pay your taxes, even though you may not have to file them until June 15th. If you owe money, that is due by April 15th. If you miss that, if you don't know that, and that's very common, especially the first year abroad, the good news is the penalties for paying late are not nearly as severe as the penalties for filing late. So you'll have lesser penalties and a little bit of interest if you pay it late, but you won't have this deeper failure to file penalties. If you need more time, and that's very common when you're abroad, you may need to file your other tax returns first before you know what you want to get a credit for. You can apply for that additional time to October 15th. You just have to do that by your deadline based on where you are, either June 15th overseas or April 15th if you're in the US. If you are serving in a combat zone, you have a filing deadline that is 180 days after your last day of qualifying service. And you don't have to do anything special for that. That applies to everything, including collections efforts, anything the IRS might be expecting from you, they don't expect until at least 180 days after you return. Again, these are a few little special military considerations. June 15th when you're stationed overseas, again, with no action necessary or required on your part. Your military income is not considered foreign, even if you earn it while you're abroad. But income from those entrepreneurial ventures, those investments, incomes that your spouse or dependents may have is considered foreign income. Foreign investments require you to report them to the US, to your country of residence in most cases, and certainly to wherever the investment is held. You could still have state reporting requirements. That's, of course, depending on your state of legal residence. Hopefully you are all legal residents of Texas or Florida or some other state by now, so that you don't have to deal with that. But if you do have a state of legal residence issue, don't forget those state deadlines. Those state deadlines don't always extend the same way as federal deadlines. So that's something to be aware of if that applies to you. You may have some special rules if you sell your primary residence. Typically that is allowed to be excluded up to $250,000 or $500 for married couples if you lived in it 2 out of 5 years. But if you have to move because of a PCS, you have some different rules and some leeway in that. If you have to pay any out-of-pocket expenses for your moves or for uniforms, those things are still deductible for you as a member of the military. They're not deductible for anybody else for the most part. Reservist travel is potentially deductible. I don't want to say always because there's some limitations there. And then if you have any veteran disability benefits, those are completely tax-free and they aren't even reported on your tax return. You don't have to even indicate that you received those at all. My basic final thoughts, it's just important to know your tax obligations. When do you have to file and who do you have to file a return to? Your state, the U.S. government, the government where you're living, the government where you've invested. Just make sure that you're on top of the when and the where. There are some countries that don't use a January to December calendar for their taxable income year, and that gets even more interesting. But as long as you're aware of those, then that's something that you can navigate. Tax planning is one factor to consider when you're investing. But I mentioned earlier, and I kind of went through it quickly, I know the example where the depreciation is different. So for the 7 years that you have this larger depreciation on your Japanese income, you have some income losses that you can write off against other income. It might be a great time to start a business and have some other income and then sort of swap those out. It might make a good option for laddering some of your investments to take advantage of some of that. So tax planning is something to consider, but it's not the only one. And a lot of times I don't even think it's the most important one. You just need to know what your obligations are and know how that factors into your investment so that you can make a smart decision. A good investment is a good investment, even if you have to pay tax on it. It's better to have the money to pay tax on than to not have it at all. But it is something to consider. And then proceed with caution if you're organizing trusts, especially foreign trusts or foreign corporations, because you do really complicate your U.S. tax situation. So if you are doing that, please make sure you're talking to somebody in the country where you are who wants to set that up, that's knowledgeable about how that works on both sides. Get some advice on how to navigate that. The U.S. kind of looks at these sometimes with a little extra scrutiny because they're not always used by folks for the best of intentions. And I'm sure that's not the case with anyone here, but it does really complicate things. And you just want to make sure you know what you're getting into all around before you look at those. And that is really all I have today. I want to thank you all for being here this morning, and thank you for your service and for listening to me talk about the not very exciting for most people topic of taxes. I get excited about it like Ari does, but it's just because that's what I do. So, and with that, I'd like to turn it back over for questions. And again, thank you all very much.
Okay, I have some questions from the chat.
And yes, so I think this time, Richardsha, this is our time for questions. If you want to come on and ask your question, please raise your hand and we will call you out. I've seen some people that are posting their questions on the chat. So we are going to go. I think I'm going back. We're going to read them. So I guess I'm going to start with the one in the chat. And if you want to, ask your question live, just make sure you raise your hand and I will get to you. So I think the first question I have here is, will we be able to get a copy of the slides, particularly in the info for common mistakes and tax credit? James?
I think my My audio broke up. I'm not sure that was me or
Yeah.
why.
I think
So I don't see any reason why we can't provide a copy of these
awesome.
slides. And sorry if I missed something. My audio was really messed up for a bit. Maybe we can
No.
maybe we can start with Crystal's question about, as a contractor for a U.S. company, is my pay considered foreign earned income?
Yep.
Yeah,
For
so
the right.
that is a good question. So if you foreign earned income refers to income earned while you are not physically in the US earning it. So yes. And if you are a contractor, it may also be self-employment income. And so that comes with another tax that I didn't even hit on today, but that is one of the taxes that there's not really a credit for. Although in some cases there is a totalization agreement with another country that mitigates that self-employment tax. But if you are working legally from remotely, even from another country, then that is foreign earned income. Where that can sometimes get dicey is if the company paying you is paying you as if you're in the US, if they're paying you on a W-2. But I think because you said contractor, that's not likely the case. It sounds like you're probably a 1099 employee or 1099 contractor. So yes, as long as you're out of the country at least 330 days out of a 365-day period, and that doesn't have to be 330 days in a single calendar year, but 330 out of any 365, then that is foreign earned income that you may have excluded.
And
Now, I
just
do have a question regarding that because the military base is considered U.S. territory. So would that be considered foreign earned income if the entity is located in the military base? That's what I get confused all the time, because I think it would make sense if she earned it as a, like if she was working off the premises of the base. But what do you guys think about income that was earned in a military base is considered U.S. soil?
Yeah, so if you are living and working on the base, then yeah, that's going to be, I didn't even think about that in this moment. So thank you for pointing that out. That does make a difference. So it remains U.S. sourced income if you're on that U.S. soil. But if you are earning that income and you're not living on the base and you don't have that entity somehow tied to the base, then that would be foreign earned income.
I see. Okay. Okay, because we do have a lot of people that they are, and I'm glad that you mentioned make that specification as the difference is where do you live, because many of our regulation we have people like, for instance, our military life consultants, so they are hired by U.S. company. However, because of the way they're here, they're not necessarily, to my understanding, allowed to live on base. So they live off base. So their income, when we do their taxes, it's considered foreign earned income because they live off base. But I think for military spouses that are on base, it gets tricky just because of that little difference. So I'm glad you clarified that.
That does make that is a little thing that makes a big difference.
Yeah, right?
Yeah.
So thank you. I'm sorry for jumping on the question, but whenever I see that, I kind of get confused too. So
yeah, no, that's a great point, because it is sort of minor, but it's kind of a big deal too.
yeah. And also have before, Crystal, I do have a question from Danny that says, what are penalties for filing late? Oh, I'm sorry. Is there anything else you would like to add, Crystal? I don't know if you want to get on here. Is there anything that you want to add regarding to your question? I'm not following the chat on the bottom, but
no, that's good. Thank you so much for that.
okay, awesome. Yeah, so then we have Danny asking, what are the penalties for filing late?
So the penalty is based ultimately on the tax that's owed. So if you don't owe tax or you do a refund, your penalty will be 0. If you do owe tax and you have not filed an extension and you're filing late, it is 5% per month of the balance up to 25%. And that's compared to 0.5% if you filed your return on time, but just need more time to pay the tax. 0.5% plus interest that varies.
Awesome. Okay, so we have Dane. Where is the process for filing an extension to October deadline if we're not able to make the June deadline?
That one is typically pretty simple. There's a number of companies that'll do it for you online, but it's you file a form 4868. I don't know of a way to directly file that with the IRS online, although it may be possible in an IRS account, which is a relatively new feature. The form itself, it just involves your name, your social security number, your filing status, and what you think you owe, and then you just mail it in and make sure it's postmarked by that date. And it's automatic. You don't, as long as you get that request in on time, you have an extension. You don't have to wait for permission, but you do have to get that request in.
Awesome. I think this comment is from James. Yeah, I think he had answered a little bit of that question too. So thank you.
No, I answered it in
yeah.
the chat too, huh?
Yeah. So yes, I have here Matt. I think does the comment about trust applications, I cannot see that. If we want to put a foreign property into a trust we have in the state.
I don't believe so. So if the trust is in the US, you're going to be subject to whatever laws in that state that the trust is organized. It's when the trust itself is a foreign trust or a foreign corporation that you're going to have complications. But the trust itself holds foreign properties. That's going to be a question for the attorney that's setting that trust up, but you don't have the same types of issues that I was alluding to now.
Awesome. Okay, and we have Eugene. She asked, during my onboarding contractor, part of my paperwork contained the foreign income tax exclusion notice. I'm not sure if that's I think it looked like a statement, but I am.
Yeah, it was
I think a foreign,
more like him
yeah,
sharing that that was his
sharing that.
experience in regards
But
to
to that, I do have a question, and I think Susan, I asked you when they were in breakout session, and you went over a little bit, but I wanted to know how you calculate what is more advantageous to a person if declaring foreign earned income exclusion, or just leaving it to add it to the gross income, so they can apply then for credits that you would not if you take the foreign earned income exclusion.
Yeah,
so how do you make that calculation? Like,
yeah,
I don't know.
The best way to do it, honestly, 90% of the time is to just prepare the return one way
Both.
and then switch to the other.
See.
Sometimes we know because we can look at the tax paid and get a rough idea. If you're somewhere that you've got to, you know, sometimes there's special incentives all around the world to bring businesses. And so maybe there's a business a country wants and they're offering a special tax rate for the employees of that business. We know if that tax rate is something like 15% and the people are making 150,000 US dollars, that they're going to need that exclusion to not owe tax, even if they have a few children that are under the age of 16.
Yeah.
We look at it case by case. If you're doing your own taxes, and there's a number of wonderful ways to do that too, try it both ways. But keep one important thing in mind. If you have filed using the foreign earned income exclusion in the past, you switch to the foreign tax credit, you have to wait 5 years before you can use the foreign earned income exclusion again without asking for permission from the IRS. And that permission letter is at least $2,000 just to file it. And that's not including the fee to get someone to prepare it for you. So that's important to realize, that you can switch from taking the foreign tax credit for years and years over to the foreign earned income exclusion. If your income becomes high enough that those tax credits are just not working anymore, or your children have gotten, that's usually where it comes into play. So the reason that it matters is not just which one results in less tax due. If you have a child who's a US citizen who is 16 years of age or younger, and even if you're working overseas, you are entitled to the refundable part of the child tax credit if your income falls into the right space. So that could mean as much as $1,400 of a refund to you per child that you have, even though you didn't pay any taxes in the normal way to have refunded, or in addition to some if you do have US sourced income like your military active duty pay. So that's really huge for a lot of families. And those are significant sums of money that can really go a long way when you're raising children. And if you just went straight to the foreign earned income exclusion, you could miss out on that. You won't get anything else if you haven't paid in from your other foreign tax credits, but carryover, which can be really important. So as you're investing your money, it's going to be growing for you ideally, right? That's how that works. So you start making more and more money. And some of these credits may not go very far in the early years, but they carry forward up to 10 years. So that can really be helpful when you start to earn more money and you're paying more tax to foreign jurisdictions. Those credits can really come in handy too.
Yeah. So in that way, I think that's why I read this statement. So it is advantageous for somebody to check. I think what I have seen in the past is when somebody is onboarding, they have an option to right then exclude that income. So I think it's from that point on, I think even the form that they get it's already excluded from their income. So do you think it would be advantageous to check that off? Or like back in Colorado, for instance, I had an option to do not get state taxes deducted from my pay for a military clause that they had. I think that is similar to the onboarding that Eugene was talking. Maybe she can correct me, but it's sort of like they can check that off and they would not take the taxes right away, and they can exclude that right away. Do you think it would be advantageous to check that if that is the case, or just let them take the taxes and decide at the end if they do want to do the tax exclusion or not?
Yeah, so that's going to depend a lot on your tolerance for having to maybe write a check later. When you do that, it is about the withholding. So it doesn't bind you to having to file your tax return with that exclusion, but it does mean they're not going to withhold any tax. And that can become a problem if for some reason you can't exclude the income. Maybe the contract ends soon and you don't meet that 330-day requirement or something like that. Then you could end up owing those taxes. If you're confident that you'll be away long enough to meet that exclusion requirement, the 330 days, then there's no harm in not having them withhold the money, because you can either exclude that at the end, or you can take the tax credit if you're paying another country. And either way, you shouldn't owe any money to the US, so you shouldn't be subject to penalties. But where that becomes risky is if something happens and you don't meet that 330-day requirement.
Great question. Okay, thank you. That's great, because we do see that a lot here. So thank you for that clarification. I'm moving on to Philip now. It says, if an American opens a company in Japan, what are the US tax implications?
Okay, so if some of that's going to depend on how the company's organized and who else owns it. So if you own a company in Japan or any country and it's primarily US ownership, and that would apply, like in the case of James and my company in Japan, not in Japan, sorry, Thailand. It is a US based company. We have US majority ownership and it operates in Thailand. So we do have special reporting requirements. We have a form that we have to fill out every year, and you would as well, that we have to report our ownership to the US. We have to report the profits as earned, whether we distribute them or not. And that has to be included in our US taxable income. So that is, you can't have retained earnings in the company. That's to avoid people opening companies outside of the US and sort of using them as tax shelters. So you can keep the earnings. I say you can't have retained earnings. Obviously you can retain the earnings in the company and use them for the company benefit, for operations and that sort of thing. But you have to pretend like you paid them out on your US tax return and include them in income each year. That is foreign earned income though, and it is something that you can exclude with the foreign earned income exclusion. So that's something to keep in mind, but that complicates things too. And you want to make sure if you do that, that you either get yourself pretty well educated on this Form 5471, or that you find someone that knows a good bit about it. It doesn't necessarily mean a lot more tax. It doesn't mean a lot more work.
Yeah. So thank you so much, Susan, for that. Then I think I have here, Rocky, regarding the example of investing in a property in Japan, would you recommend learning to navigate US income tax treaties, or is this topic complex enough that consulting with a professional will be advisable?
Yeah, income tax treaties are very complicated. We do deal with them. I am not overly familiar with the one in Japan. I have read it, and I have read the technical details on it and the advice on it. You're going to really probably want someone well-versed on the specific treaty in the specific country where you're investing to at least initially give you some guidance. Once you've got that in guidance, once you've got someone that has read it and has read more than just the treaty itself, there's a lot of additional documents that go with it, and has a good understanding, I think that would be a fee well spent to make sure that you understand what your choices are there and what those can do for you.
Yeah, 100% agree. I think, many of these, many of the time that we deciding to invest in real estate, starting with an end in mind and knowing, before even you set up your entity, your business, you buy real estate, you definitely want to know what you do and what the most advantageous things to do at a certain time will be helpful in, setting up your business or, buying that house. So absolutely. Thank you. I think we have one more question here. Aya, I'm sorry if I'm not saying your name correctly. We owe a house in Japan. So when we file jointly on federal income, what are some of the things I need to look out for so I won't get into tax issues?
Okay, so is it the house that you live in? Or is it a house the house that you live in? So you would be able, if you have a mortgage on that house and you're paying interest, that interest is potentially deductible on your US tax return. Now, whether or not you take that deduction or it matters will depend on whether or not you're itemizing or using the standard deduction. And that's really probably the only thing to look into. If it's the house that you live in for now, that's the only thing. Take a look at the interest that you're paying. Make sure that you're including that when you're trying to determine if you're going to itemize deductions or take the standard deduction. And that's really it. When you sell it, you'll have some other issues, but for now, that's all. Keep a good record of what you paid for it, what the costs were to acquire it, things like any commissions you may have paid or fees. If you make improvements to it along the way, keep records of that, as those can help mitigate any tax that you could potentially owe if you sell it for a great big profit. And really, that's about all you would need for now.
Awesome.
You're welcome.
Awesome. This is great. This is great. So I think I have read most of the question. If I miss your question here, Ritarsha, do you see anybody with raise hand? Did I miss anybody else?
I think you got them all.
Oh, perfect. I
was
think
gonna say, could we James, I didn't know, there were a couple times where I thought maybe you'd want to add. Were there other things that you wanted to add to anything that Susan has already shared?
A couple things that I can think of is you can use, so if you're living in Japan or abroad for 330 days or more, that foreign earned income exclusion, and this is where people also, I've met a lot of people that have this wrong. You can be paid out of the US into a bank in the US. That has nothing to do with being eligible to use that exclusion. It has everything to do with where the taxpayer is physically located for a 12-month period. So out of the US for 330 days in a 12-month period, they qualify to use that foreign earned income exclusion. And so some people think that they can't because they're being paid from a U.S. source into a U.S. bank. That has nothing to do with it. I think Susan's covered everything else. I mean, we're happy to. A lot of these get, especially with the U.S. Military bases, and whether you're working for the government or a civilian or a contractor, it's really a case-by-case basis a lot of the time. So we're happy to meet and answer questions individually as well.
Yeah. That's great.
So James,
Um,
I'm curious because I think when you and I had originally talked, you were saying that a lot of your clients, you have clients who were previously active duty, ended up retiring, and then relocating in Thailand. I'm curious because I think we've talked a lot about Japan, but I will personally share it. One day I would love to be that person that lives in Thailand. So would you mind sharing what are some things to consider if you were to reside in Thailand and get foreign earned income there?
Well, if you're retired here, so foreign earned income exclusion only works for income made from wages, a salary, and so forth. If you're living here and working remotely, for example, you can still use that, but any sort of contract work is susceptible to that 15.3% additional tax that you have for Social Security and Medicare. People living here, all sorts of, especially former military living here in Thailand, Philippines, all over Asia Pacific, really. I meet a lot of these people. One thing I can think of that's coming up a lot lately is there's a lot of anytime you have the US involved taxing people based on their citizenship, it always tends to run it runs into issues with whether or not a country like Japan or Thailand can tax you as well if you are their resident. One thing to consider, and this goes back to the tax treaties, and I'm dealing with this a lot now, is retired military that have Department of Defense, any US federal funded retirement is taxable by tax treaty. In Thailand, it's taxable only by the United States. So there's a lot of consternation right now about Thailand potentially taxing people who are in Thailand for 180 plus days on income remitted into Thailand. If their only source of income is that Department of Defense retirement or Social Security, by tax treaty, they are specifically taxable only in the US. They never have to worry about anything other than just their normal US tax return. And so that tends to apply to a lot of the countries that have bilateral income tax treaties with the US. If you have US federal funded pensions, thrift savings plan, OPM, DOD, those tend by tax treaty to only be taxable in the US. And that actually that clarification makes things a lot easier for people who are former military, and that's the mainstay of their retirement income. And it typically is less tax than if you were trying to pay, for example, the Thai Revenue Department on that same income.
and I do have a question regarding that, James. Is there a way to find a list of countries that will tax your retirement pay? So a lot of us are dreaming to live outside United States during retirement. So I think that's one of the things that you want to consider when deciding when to leave after the military, as we do get the retirement from the military.
Well, if you have U.S. military retirement, most places, I would say if you're retiring abroad, most places abroad aren't going to tax you on your U.S. military retirement, because typically if the U.S. has a tax treaty with those countries, they are certain to want to be able to tax their federally funded pensions. So usually you're not going to, by tax treaty, be able to get out of paying US income tax on that. And so that this is different. If you had like a Boeing pension plan in some countries, that pension plan would be taxable in that country, and then you would have to use a treaty position and tax credits from that country to go not taxable in the US. But for US military retirement, typically you're not going to be paying anything to any foreign country on that. But along the same line, you're not going to be able to get out of paying the IRS on that income as well.
Okay, that's interesting. I'll be interested in kind of reading which countries do. Are you aware if any country will make you pay for that income for retirement?
On US military retirement,
Yes, when you live abroad. Yeah.
so as if you are paying your tax to the IRS and then another country wants to tax you on it as well. The ones in this
Yes.
immediate region, no.
Oh,
That
okay.
you're
Okay.
going to be paying
Yeah.
the US and then you're not going to be paying those
Anything
countries
else?
in addition.
Okay. Interesting. Awesome. That makes me feel much better about Spain.
If I could ask a follow-on, it's not specific to tax, but just because I feel like you're in an interesting position to be able to get this type of feedback. But I'm curious, with the clients that you have that live in Thailand, Japan, Korea, have any of them expressed like were their desires to live for, like with some of the things that attracted them? Are you finding that it's mostly because they just have the affinity for that country itself, or their spouse is originally from that country, or like what are the qualities that drew them to there? Because I feel like, you know, you're probably in a better position to talk about that than so I
What
just didn't know.
like Americans to living, and
Mhm.
it's I would say the number one thing has to do with cost of living.
Mm.
People that go back to San Diego after 30 years and they just can't have the same quality of life that they could if they were living in part of Thailand because of just the crazy increase in the cost of housing and living, for example. So the number that tends to be number one is people uh, just for cost of living choose to retire and live abroad. The second is just like you said, lifestyle. People love it here. People aren't here in hardship, if that makes sense. People can come out here, have a lower cost of living a lot of the time, and have a great life, great food, have an adventure in their retirement. A lot of people have a lot of people I deal with have spouses from the countries that they're living in. That is true, but I think by far and away the number one is just cost of living.
So thank you so much for sharing that.
Yeah, anything else you can think of?
Thank you so much. I think at this time, team, this is our 10 minutes. We get about if you have any other question, please speak now or forever hold your peace.
Yeah, I was gonna say, I know some people still have questions, and I know some people tend to be shy on asking. So on
Yeah.
the screen, we do have your email address and website. But Susan, can you
Yes.
other ways that the people who attended today can connect with you? Is there a preferred way to get in touch?
Email is probably ideal. And my email is similar to James. It's just susan@americanasiatax.com. But if either one of us, it can come to either one of us and we'll get the answer you need.
Awesome.
I will
And
drop
remember,
that.
if in the meantime you think of any other question, we are going to be hanging out for a little bit after we end the formal presentation.
Oh, I'm sorry. I know we're gonna
that'll
close out,
be
but Ari, your audio for some reason is going in and out. Can everyone hear me okay?
Yes, I hear you.
time to
Yeah.
ask new question.
Yeah, sorry, Ari, your audio is kind of cutting in and out. I'm not sure what's going on. But there was one more question here I think everyone would benefit from, and it's from Danny. He says, "What is the best way to compare countries by their cost of living?"
I'm trying to see if I can find it right now. There's a website that I like to use. I don't know who. I'm probably going to send it's probably some competitor. Let me see. Oh, here, this one. And I just like it for its ease. It's probably full of ads, so be aware of that. It's I'm not sure how to say it. It's Numbeo. And you can select the country where, so you can compare from where you are to somewhere else, not necessarily the US to somewhere else, which is
So
what I
it's
like
a
about it.
comparison
You can
tool.
compare Thailand to Australia or wherever you're considering.
Oh, that's neat. Cool. Susan, would you mind dropping that link to that on the chat?
Yep, there it is.
Awesome.
Here,
All
let
right.
me put
Ari,
it.
how's your audio? Can you?
Yes, can you hear me now?
There we go. Good.
Yay, we're back. Good. Just internet problems, right? Well, thank you so much. This has been an amazing presentation. I can talk for hours here. I love this. But thank you so much for sharing so much knowledge with us, for your time and being here. I really appreciate it. So, please, Ritarcha has just put the survey link. Take a moment and complete it. It promise you will take 1 or 2 seconds. But it does help us a lot to make sure that we're bringing topics that interested you, something that you want to know more of. So yes, please don't forget to complete it. You can do it right now as I finish sharing more information. So next, we have been working backstage a lot, guys, to set up a whole year of wonderful events. So now we are ready with our 2025 program. Our next meeting is going to be March 15, and it's going to be an amazing meeting. We have great guest speaker, and we will put all of this information on our social medias. So again, make sure you're following us, you're like that Facebook page, and you join us on Instagram. Also, we are very excited about April 4th and 5th. We're going to have our 2025 Asia Pacific Real Estate Investing Summit in Guam. And Anne is going to speak to that in a little bit. And then we will have May 17. The next one is July 12th. And the last meeting of the year is going to be October 18th. So again, make sure you're following us. And so you get to join us in all these wonderful topics. So now I'm going to have Anne. She's going to share more information about our Asia Pacific Real Estate Investing Summit.
Yeah, so just save the date. For those of you who don't know, is this first time you guys are introduced to our community and the things that we do virtually. This is a virtual community, as a lot of us, like Ari, Ritash, we also have local in-person chapters. But one of the things that have come from this, and the fact that we've done this for the last 2.5 years now on a voluntary basis, is a lot of us have only met virtually. And so we were like, what can we do to finally get to meet everybody in person? And so what that has led us to is actually doing a event. Basically, we're just calling it the Asia Pacific Real Estate Investing Summit. It will be held on Guam over Dodea spring break. So I know a lot of you probably have families, and if you have families, you're probably thinking about, what are we going to do for spring break? Well, I'm happy to share that we have an opportunity for you to enjoy your spring break on Guam, where we get to talk about real estate investing, as well as networking and connecting. The other thing you'll get to do is experience the culture of Guam. So the Chamorro people are the indigenous people. There are a lot of things about our culture that are unique to this part of the world. And so the next slide I'm going to show you is actually the program. We did this we had the inaugural event last year. This is what it looked like. It was a 2-day program. As you can see, the way it's broken out is we do everything by master classes mostly. So that means it's not just someone standing in front talking to you or at you. It's more of someone engaging with you on the topics of interest. And so every time you go to a master class, there's 3 rounds. You actually get to choose which one you want to take part in. So if you're interested more on the financing side, or you want to know about short-term rentals, or you want to figure out the whole BRRRR method, like all the topics are there. Again, the program is designed so that you get to pick and choose the things that are of interest to you. But the bottom line is it doesn't matter if you are a starter investor, as in you just are interested and you want to figure out what that could look like for you, or you're someone who's seasoned. All the topics that you experienced in the day 1 program is all about things to enable you to get to your goals. Day 2 program is all about Guam, actually. So if you've never been to Guam and you want to understand what real estate looks like here, that's the program for you. And what's really neat about the way this is designed is that it's not only about the information, right? It's also about, we're going to take you out and actually look at property, because there's just something about, some people learn by reading, some people learn by doing. This program for this day gets at both. And so you'll get to experience a little of both. And of course, with both days, everything is included in terms of food and transportation. The one thing that I always tell people that's great about this overall is that everything is curated for you, meaning you basically got to know what the program has to offer. If it has your interest, everything else that you would normally have to worry about or stress about is removed from the program so that you can get here, just be a sponge to absorb, and just make as many connections as possible. So we're going to keep this same format for this upcoming one. We already have a date, April 4th, 5th. We already have a venue. It's going to be Hyatt here in Guam. If you want additional details, we'll be making the registration go live this next week, and we will have early bird pricing, so definitely stay tuned with that. So with that, I'm going to turn it back over to Ari.
Awesome. Thank you so much for sharing so much good information. I'm so excited about that. And I've never been in Guam, so it's going to be super cool being. So stay tuned for more information about it, guys. Again, please, all of our social media platforms are live. So I believe Ritarsha has posted both links, Facebook and Instagram, in the chat. So make sure you are liking and follow us. I think next we have, again, this event is made possible through the volunteer efforts of the team members of Asia Pacific Investor Network and ADPI Asia Pacific region. So big shout out to all the people working in the back to make this possible. Together, we're committed to creating exciting opportunities to network and learn for our community who share our passion in real estate investing and entrepreneurship, especially while living overseas. So shout out Mark, Ritarsha, Winnie, Wei, Erica, Dane, many people making this possible. And we're looking for a new host in our 2 different locations in Japan and Korea. So if this is something that interests you, please reach out to us. We would love to talk with you and kind of share what this opportunity entitles, and it's amazing. So if that's something that you would like to do, just reach out to us. We have our you can reach out to either one of us, or we have our team our team email there. Either way is fine. So at this time, I am going to do our closing remarks, and I want to start by thanking our guest speakers. Thank you so much for your time. Thank you for sharing so much information. I truly enjoy our Q&A, such wonderful engagement. So thank you so much for being here with us. Thank you to all of you for joining us today and engaging and turning your camera on. And, last but not least, thank you so much to the team that, spent hours like, oh, this is not working, freaking out, or like, okay, it's gonna happen. So to bring this to all of you. So thank you. And at this time, this concludes the formal portion of our event, and we are going to stop recording. But please stay on if you want.